Hey everyone, and welcome back to the channel. If you've ever stared at a stock or crypto chart and felt completely lost, like you're trying to decode some secret message, then you're in the right place. Today, we're re-breaking down one of the most fundamental concepts in trading and investing, understanding price charts and, specifically, the different time. By the end of this video, you'll be able to look at any chart and know exactly what story it's telling you. So, grab a coffee, get comfortable, and let's dive in. First things first, what is a price chart? Simply put, it's a visual representation of an asset's price movement over a period of time. It shows you the battle between buyers and sellers. But the key phrase there is over a period of time. This is where time frames come into play. A time frame is the specific period that each candle or bar on your chart represents. This could be 1 minute, 1 hour, 1 day, or even 1 week. Choosing the right time frame is crucial because it completely changes the perspective and the type of information you get from the charts. It's like using Google Maps. You can zoom in to see the street view or zoom out to see the whole country. Both views are correct, but they serve very different purposes. Let's start with the smaller time frames, what we call the lower time frames. These typically range from 1 minute or 1 meter up to about 15 minutes or 15 meters. On a 1-minute chart, each candle represents 60 seconds of price action. Who uses these? Mostly day traders and scalpers. These are traders who are looking to get in and out of trades very quickly, sometimes within minutes or even seconds. They're trying to capture very small price movements. The advantage here is that you get a lot of action and many potential trading opportunities throughout the day. The downside, it's incredibly noisy. There's a lot of random price fluctuation that can easily fake you out. It's like trying to listen to a conversation in a packed stadium. It's chaotic and can be very stressful. For beginners, I generally recommend staying away from these super low time frames until you're more experienced. Next, we move up to the mid-range time frames, like the 1 hour or 1H and the 4 hour or 4H charts. These are a favorite among many traders, including swing traders. On a 4-hour chart, each candle represents 4 hours of trading. These time frames filter out a lot of the noise we see on the 1-minute chart. They give you a much clearer picture of the market's intraday trend and structure. You have more time to analyze a setup, make a decision, and manage your trade. You're not glued to your screen every single second. Trades on these time frames can last anywhere from a few hours to a few days. This is a great middle ground. It provides enough detail for active trading without the constant stress of the lower time frames. If you're new to trading, the 1 hour or 4-hour chart is an excellent place to start learning to read the market. Now, let's zoom out even further to the higher time frames. We're talking about the daily, or 1D, the weekly, or 1W, and even the monthly chart. On the daily chart, each candle represents an entire day of price movement. These time frames are used by swing traders and long-term investors. Why are they so important? Because they show you the big picture. They reveal the major, dominant trends in the market. A trend that's as visible on the weekly chart is far more significant and powerful than a trend you see on a 5-minute chart. These time frames are less about the day-to-day noise and more about the long-term direction. For investors, looking at weekly or monthly charts helps you identify major support and resistance levels and understand the overall health of an asset. Patience is key here, as trade setups might take weeks or even months to play out. So, which time frame is the best? The honest answer is, there is no best one. The right time frame for you depends entirely on your trading style, your personality, and how much time you can dedicate to the markets. A day trader needs the lower time frames, while a long-term investor will focus on the higher ones. The real magic, however, happens when you learn to use them together. This is called multi-time frame analysis. You can use the weekly and daily charts to identify the main trend. Are we generally going up or down? Then, you can zoom into the 4-hour or 1-hour chart to find a precise entry point that aligns with that bigger trend. This way, you're trading with the flow of the market, not against it, It's like having a map and a compass. One tells you the destination, and the other helps you navigate the path. To wrap it all up, understanding time frames is non-negotiable if you want to succeed in the markets. Don't just pick one at random. Think about what kind of trader or investor you want to be. Are you looking for quick profits or long-term growth? Start with the higher time frames to get your bearings, then zoom in to find your opportunities. Practice switching between them on your favorite charts, and you'll start to see how they all tell a piece of the same story. That's all for today. I hope this breakdown helps you feel more confident when you look at a price chart. If you found this video helpful, please give it a thumbs up and hit that subscribe button so you don't miss our next videos. Got any questions? Drop them in the comments below, and I'll do my best to answer. Thanks for watching, and I'll see you in the next one.